Hi, this is Jerry Bowyer for the Eagle Investing Network. Thank you for watching. Time to hit subscribe button if you haven't, and also to tell other people about this channel so that they also can get the kind of education that you're getting right now, absolutely for free. We're going to talk today about markets and how markets know more about the economy than economists. Now, I'm an economist, so it's not easy for me to say, but economists don't know as much as we pretend to frequently. And you watch people on cable TV making predictions about the future, and the qualification for being on the air is to be interesting, not necessarily to be right. But people who are participating in markets, which is billions of people, have skin in the game. So the kind of decisions that they have to make are about making or losing money, not about being interesting or uninteresting. Also, all of us know more than some of us. So the knowledge is dispersed, as Friedrich Hayek says, throughout the entire economy. So markets reflect the widest possible amount of knowledge. They're not perfect. No human institution is, but markets know a lot. Let's look at the data and I'll tell you what I'm talking about. So here we're looking at three lines. As you can see, that one is Treasury yields, that orange one we just clicked on. So that's 10-year Treasury bonds. And when people are liking treasuries, when they're buying treasuries, and people might include the central bank at this point because the Fed has been really interfering in these markets a lot, that causes them to come in here and they buy treasury bonds, and that drives the price up and that drives the yield down. The reason that the price going up means the yield is going down is simply because it's a fraction. This is a ratio. So a yield is the interest payment divided by the price. So if the price is going up, and that's the denominator, well, then the whole fraction has to be going down. What we've been seeing happening lately, however, is that people have been getting out of bonds, signaled by the Fed. So the central bank has been getting out of bonds. Investors have been getting out of bonds. Investors have sold these bonds thinking, well, the Fed's going to sell them, so I want to get out ahead. All these combinations together means that people do not have the same amount of confidence in treasury bonds, and they've been moving out of them. And so what happens when they do that? The price of the treasury bonds goes down and the yield goes up. And if you're a treasury bond investor, you already know what I'm talking about. You lived through it. A lot of financial advisors, I think, made a terrible mistake. Not all of them, not the ones who really know what they're talking about. Traditionally, there's been this idea that stocks are risky and bonds, especially treasury bonds, are safe. Well, that is a grotesque oversimplification. And so what happens is there's a tendency for some people to automatically put their clients in treasury bonds the older they get. The famous 60-40 split, 60% in bonds and 40% in stocks as you're moving into retirement. The problem is that treasury bonds are risky sometimes. They're risky when the yield is extremely low, as we see here. We've seen some of the lowest yields in 200 years. That's a bubble. And so there's a lot of possibility of those bonds becoming less valuable. And that's exactly what happened right there. It's exactly what happened. Safe? I don't think so. That's a sell-off in treasury bonds. All right, so that's the bond world. Here is the stock world. So instead of looking at the interest rate divided by the price, what we're doing is looking at the earnings divided by the price. Why? Because earnings are what you're buying. When you buy a bond, you're buying interest payments in the future. When you buy a stock, you're buying earnings in the future. Now, you don't know the future earnings, so you use the present earnings as a kind of an estimate of how valuable this is. And so why are earnings so important? I get paid through dividends, Jerry. Well, the dividends come out of earnings. Well, no, Jerry, what happens is I get paid when the company buys stock back and concentrates the ownership and drives the price up. Okay, the stock buyback is paid for out of earnings. Well, I invest in growth stocks and I get paid when the company becomes more profitable in the future. Okay, the more profitable in the future came from them reinvesting earnings internally and making themselves more profitable by expanding or innovating or research and development. However you slice it, it all comes out of earnings. So what you're buying is earnings. All right, let's go back and take a look at the data. And so the same deal here. When they're getting out of bonds, the interest rate yield rises. When people are getting out of stocks, the earnings yield rises. But they don't, as you see, they don't move in sync. So what we did here is we have taken a spread between them. So for instance, at the moment that the earnings yield for stock was here and the interest yield for Treasury bonds was here, see, that's a big gap. That's a spread. The green line is the spread. The reason this is so high is because this spread is so large. And what that means is this spread. So we're going to go to a different chart here, and we're going to look at just the spread. Now, this is just the spread here. So this spread is a measurement of risk. So if people are, for instance, very concerned and they're selling stocks and buying bonds, that spread gets really big. Remember, we saw that big spread between them? Well, here, this is just the spread. We've taken out the top line and the bottom line. So this is just the difference. So this is fear. March 31st, 2020, a lot of fear. How about here? Yep. There was a lot of fear in 2011. People forget that, but there was a global recession. Remember this? The Great Recession? A lot of fear. Before that, maybe a little bit of arrogance, like maybe there wasn't enough fear before that. Maybe here this was showing very low levels of fear in 2007. Stock prices were very high. And so that made the yields low. And so the spread was very low. So this wasn't realistic. People were too optimistic here, too pessimistic. So this spread basically gives you some idea what the market is saying. So remember, if somebody sells Treasury bonds, you don't know why they're selling Treasury bonds unless you know what they're buying with the Treasury bonds. If somebody is getting out of one asset, you don't know for sure what's going on unless they're getting into another asset. Or if people are buying Treasury bonds, well, what did they sell in order to get the money to buy Treasury bonds? If they sold stocks, risky, and bought bonds, risky in terms of growth future, and they bought bonds, which are perceived as less risky, well, then that means they're afraid. If, on the other hand, they sell bonds and buy stocks, that means that they're taking the lottery ticket. Stocks, you don't know what's going to happen, but it's probably going to be good, as opposed to the sure thing, which is bonds. So this thing measures risk perception by markets. Doesn't measure it perfectly because the Fed is in there with their thumb on the scale messing things up. So it doesn't always give you what the market is thinking. It gives you a combination of what the central bank and the market are thinking together. Okay, let's take this line and break it down into individual dots. And now we're going to rearrange them, not according to time order, but according to this fear metric, equity yield premium. That's a technical word. I mean, you want to look it up on Investopedia, you can. But let me just tell you, this is the fear measurement based on the preference for bonds over stocks or for stocks over bonds. And what we see here is, you see there's kind of a negative slope to the line. The more scared the markets are, as you're going down here, you're coming, see, that's because it's a negative slope line, you're coming down in what happens in the next year of GDP. This is about where we are now. So that's forecasting about a 2% growth rate. And that seems to be a reasonable supposition as to where we are. Okay, so there we have the market's wisdom. The wisdom of crowds, especially when we're looking at the stock and bond market. Now, there are other things to look at, like, for instance, the corporate bond market, which acts a little differently than the stock market. We can look at spreads there. We can look at the spreads between regular Treasury bonds and inflation-protected Treasury bonds, which gives you some idea of how much fear of inflation there is. And you're probably not going to be surprised. I'm going to tell you in advance that they were right, that these markets signaled rising inflation risk when the Fed and a lot of the pundits were completely clueless. The market knew what was coming, but we'll look at a little bit more detail when we get into those in the future. So this is the wisdom of markets. This is what the stock and bond markets are telling us about growth expectations. And you've been watching the Eagle Investing Network. I'm Jerry Bowyer. Hit subscribe. See you later.